The gold tsunami is surging with the fury of 1,000 tempests, and Bank of America's stark $5,000 vision for 2026 is the siren song echoing over the waves as the USD plunges 7% year-to-date into hawkish headwinds. The 10th of December, 2025 today, as the sun crests midday in the canyons of Wall Street. The Federal Reserve unfurled its third-rate incision of the year this morning, a slender 0.25% shave that delicately dialed the federal funds rate down to the tenuous 3.5 to 3, 75% threshold. A verdict the volatility vaults had vaulted at an unyielding 87% certainty. Yet Jerome Powell's podium proclamation from the marbled halls of the Eccles building, it resonated with the resonant rumble of hawkish restraint, spotlighting a core PCE inflation rate tenaciously tethered at 2.8%, and cautioning that the road to lower rates remains fraught with uncertainty, delineating a 2026 trajectory of a parsimonious 2 additional quarter-point concessions, not the cascading cascade of capital the carry trade cabal had convened to celebrate. The dollar index, in thunderous thunderclap, didn't demur. It plummeted to 99. 2. Etching a 5-week abyss that's hemorrhaged a harrowing 7% year-to-date, its most malnourished mark since the tariff tornadoes of summer scorched sentiment into submission. Gold, amid this maelstrom, didn't deign to drift. It detonated to $4,216 an ounce, a resounding 55% year-to-date rampage that's raising record ramparts, with silver searing silver at $61 in symbiotic savagery. But what wedged like a wedge in my windpipe this forenoon, as I foraged through freshly forged Bank of America dispatches with the Dow's digital dirge droning in the distance, was the unvarnished upgrade. BofA's Precious Metals Vanguard, helmed by Michael Widmer, hoisting their 2026 gold oracle to $5,000 per ounce, a 19% vault from today's vista, averaging $4,438 for the annum, propelled by a 14% swell in investment ingress mirroring 2025's mania, central bank consecrations cresting 800 tons quarterly, and fiscal fissures fracturing under 350 trillion in global gravitas. Why this prophetic proclamation now? As the USD's 7% YTD plunge paints the hawkish warning in blood-red brushstrokes? My theory, tempered in the torrid forge of twilight trawls through custody crypts and council communiques, is that this tsunami transcends tidal T's, it's stage 3 of a 4-stage cataclysm that's cataclysmically carved commodities from the coin clips of Caesar to the crude crises of Carter. The Fed's feigned felicity has fractured the dollar's dike, deluging the destitute toward durables in desperate durance, but those hawkish harmonics? They're the hidden harpoon hurling us toward stage 4, where gold's glide to $5,000 by Q4 2026 isn't a graceful gallop, it's a gravitational gut punch. Premiums prefiguring the purge as BRICS bastions blueprint gold clauses to bisect dollar dominion by 30% trade tilt. Industrial infernos from photovoltaic phalanxes to voltaic vanguards, vampirize vaults at 3,500 tons yearly against extraction's ebb. Central cathedrals consecrate 1,200 tons in 2025, gospel up 20%. Yet gold's golden genealogy, as fiat's foil and fiscal firewall martyrs, it as the messiah of this monetary maelstrom. At $4,216, gold isn't gilded. It's grotesquely ground down amid debt's 350 trillion dirge and fiat's 54-year phantasm post-Nixon's 1,971 notch. The portal to pilfer physical before the tsunami tidies the timid and the hawkish headwind hardens into hurricane. It's splintering under BofA's bold banner and buckling beneath the USD's unrelenting undertow, but you still shoulder the sledgehammer if you swing it before stage 4's surge scorches the stragglers into sterling submission. Before we wade into this wave-whipped warning and the dollar's doomsday dive, let me buttress the bulwark with brutal, unblinking candor. I'm not a financial advisor, and nothing waiting from this watery wake constitutes counsel in coin or creed. This is unsparing educational endoscopy from public pantheons, the exhaustive COMEX custody canticles, BofA's bullish briefs, IEA industrial imprecations, Bloomberg's hawkish headlines. I've waded through these watery wilds like a whaler in a white squall, bolting the breakers into bastion, and the bulwark barring our bay is no bogeyman, it's the self-same, surge-seasoned sentinel that systematically stripped the speculators and sovereignly sanctified the seers across gold's gilded gospel. To truly trace why the gold tsunami crests with Bank of America's $5,000 seer's sight as the USD's 7% YTD plunge paints the hawkish warning in perilous pigment, catalyzing a global gale that guts fiat's facade. We must meticulously map the four-stage monad that's methodically mangled markets, from the aureate adulterations of Augustus to the OPEC oil odysseys of October 73, a formidable firmament where complacency cements the catacomb of the credulous. Expansion etches the escarpment of excess. Recognition rends the rampart of reality. An eruption engulfs the edifice in eschatological ecstasy. This archetype isn't airy alchemy alchemized from arcane ether. It's alighted from the anvil of antiquity's anvils, from the blight-blasted barrenness of Ireland's 1,845 potato purgatory to the Russian-rigged rigidity of Palladium's 2019 to 2020 plague, and now it hammers gold's hallowed hammer with the USD's 99.2 nadir as the necrotic nexus. Stage 1 is complacency, the cloistered complot where copiousness cultivates the canker's covert cradle. Envision the post-1971 Nixon notch, gold nudged to $35 an ounce in numb neglect, central cathedrals cascading 500 tons yearly like confetti at a coronation of credulity, paper phantoms, proliferating futures exploding, 50-fold physical, GLD ETFs germinating in 2004 with notional claims eclipsing vaults 100 to 1, open interest overindulging to grotesque multiples of deliverable bars. Complacency commandeered the collective consciousness. Debt dormant at 50% GDP, industrial gold idling at 3% ingestion, 8 mines marshalling 3,000 tons annually with scornful superfluity. Fiat, freshly forged and unbuckled, but unbowed, unquestioned, as the unassailable umpire of unlimited utility. The system slumbered in smug serenity, hoard the holographs of hollow promise, hail the handlers of the hallucination, disregard the dirge of depleted depths. Complacency compacted gold's intrinsic worth into a coiled catastrophe, a camouflaged catapult cloaked in the calm of collective credulity, cocking the crossbow of crisis with cruel cunning, priming the powder keg for the Beaufet oracle's private pyre. Stage 2 is expansion, the encroaching entropy, where escarpments erode inexorably, but empires endure in egregious error. The 2000s dotted it with dot-com detritus and housing hydra, M2 money supply swelling 50% in the aughts, Fed funds at 1% inflating bubbles till 2008's Big Bang Lehman liquefied, 30 trillion QE quay from global granaries, Fed's folio fattening eightfold. Gold growled from $300 to 720 inches crisis nadir, then 1,923 by 2011, a 167% growl. But suppression shackled. Banks like Beaufet's peers shorting futures, derivatives deluging to feign flood, prices probing then pinned. Central banks pivoted subtly, net buys trickling 500 tons by 2015, COMEX eligible swelling 500 million ounces, claims outrunning reality 200-fold. Expansion excavated the gulf. Debt to GDP from 250 to 350%, inflation veiled by CPI conjury, gold's allure as negative real yield haven buried in zero-rate zephyrs. China's entry, reserves budding from 395 tons, 2,000 to 1,000 by 2010, diversifying dollar dumps amid RMB ascent. Yet surge stewed undervalued, policymakers preening as debt dragons distended, the stage set for shatter under hawkish haze. Stage 3 is the break, the breach where semblances splinter and Beaufet's $5,000 siren shrills. This is our now. Nucleated by today's Fed trim and USD's 99.2 nadir, awakening to mining's malaise. Central hordes hammering 1,200 tons, 2025, up 20%. Beaufet's upgrade the clarion. COMEX registered, slashed 25% YTD to under 10 million ounces, eligible 500 million but strained surfacing as lease rates nudge 2%, backwardation brushing with spot premiums nipping futures 10 cents. ETF inflows, GLD 300 tons quarterly, 2020 echoes, physical premiums 2 to 3 over spot, Kitco queues lengthening. Geopolitics goads, Taiwan tempests hike 20% haven bids, Mideast flares reroute oil 10%, BRICS blueprints gold clauses, 20% reserves fleeing dollars by 2027. IMF murmurs. The Fed snare? Cut buckles USD 7% YTD to 99.2, beckoning bullion bids. But hawkish persistent PCE halts easing, yields rebounding 0.5 point to 3.8%. Volatility vitriol scouring specs before sprint. Beaufet nails it. $4,438 average, 2026. $5,000 Q4 on 566 tons investor quarterly, plus Central 800 tons. China's 300 tons YTD. Russia 200, EM ditching dollar at 20% clip. Undervaluation indicts. Gold's cap 13 trillion trails. Bitcoin's froth, yet anchors no hype 200,000 tons above ground. Output capped 3,500 tons as grades gutter 30% decade. Beaufay's hawkish warning. The traps tell, cuts lure, but inflation rebound mandates pause, supercharging gold as fiscal foil. Stage 3 throttles shorts, $4,216. The breakouts bellow $5,000. The tsunami's tide, or window warps as premiums prelude. Stage 4 is eruption, the tsunami's towering torrent where quotes quake to Beaufay's $5,000, USD's 99.2 wreckage, the wave's wrath. Sovereign salvo. China unveils 500-ton quarterly, BRICS codifies clauses, COMEX claims surge 50% as ETFs swap synthetics for sovereigns. Yields yo-yo in Fed trap. Cut negatives lure 20% EM exodus. Inflation 3. 2% core compels curtail, $1 to 95. Gold's cost collapses minus 1% real. Beaufay math. 566 tons. Investor Q1 2026. 800 Central, mine shortfall. Buffers 50,000 tons, blasted in months. Gaps gape, 4,216 to 5,000. Q4 on cut tailwind. Tsunamis roar as trap bites. Inflation spirals 4%. Emergency easing. Dollar hegemony phrase. COMEX curbs weekly. Defaults 20%. Suits swarm GLD's cash clauses. Short squeezed 100 billion unwind. Premiums puff 20 to 40%. 5,000 spot yields, 6,500 eagles. Mints, moribund years. Traps tango. Hawkish cut lulls. Debt service 2 trillion 2027 prints. Inflation 4%. Cuts cascade. Hegemony hemorrhages. BRICS 30% gold trade by 2028. Counter skeptics. Yields rise. Gold lags. Trap twists post-pause print plunges them. 2011's 1,923 proof. CB's dump. Reversal rigid. Buys since 2010, 1,200 tons, 2025. Shatter, no retreat bar, deflation delusion. Industrial subs, gold's 5% jewelry, investment core, tech purity, peerless, recycling 30% ceiling. Mines multiply, 10 to 15 years infancy. CapEx crippled, post 2011. Output stagnant despite $50 leap. Demand dips, geopolitics guards, fiscal fissures forge, IRA subsidies, silverline gold and green. This epoch's earthquake. 1,971 fiat genesis meets 2008 QE eternity, but 2025 debt Armageddon, 350 trillion, 10% GDP, servicing snares, Fed checkmate, cuts, Kindle inflation, Kindle cuts, gold recalibrates as fiat's phantom bane. Beaufay's 5,000 no apex, 2,028, 6,000 whispers base if BRICS bolts. Undervaluation at 4,216. 40% shy inflation fare, 7,000 historical. 70% below multi-year maps. Eruption vaults at 5,000, Q4 2026. Cascade 5,500, mid-2, 027 as trap tires Fiat's thread. Not query Quicksilver of quandary in, quandaries quick. As Beaufay's $5,000 tsunami tidies the timid amid USD's 99.2 Nader and Fed traps tangle, the breakout beckons not blind bets, but barricaded bets, possession over punt, resilience over recoil and recoil's resilience. First, vow to verifiable vault. Spurn ETF ephemera with cash traps and futures fiascos that felled 2011 flotters. Hail minted monarchs, American gold eagles, maple leafs, kilo Perth purity proclaimed for frictionless frontier flips, premiums 1 to 2%, overspot your bulwark when they burgeon. Harvest from hallmarked like APMEX, serial scanned, sans spurious surges. Second, harvest hastily physical 10 to 20 over spot present, but breaks bellow balloons to 100, 200 as COMEX creaks. Fed cut courts but trap teases tapers, stagger scoops, sub 4,000, 200, 10% parcels, pairing the pattern's pulse. Third, portion prudently. 10 to 15% portfolio for ballast golds. 1-0 to 1 trap triumphs historical up to 20 if debt alarms toll louder. Blended with silver's spark or treasury's yield net against rogue waves. This hedges the math without betting the farm. Fourth, secure custody unyieldingly. Home safes for tranches under 10 ounces, fireproof, bolted, insured or allocated private vaults like Delaware Depository for scale, keys in your hand, no counterparty creeping in via bank boxes or custodian fine print. Audit annually, diversify locations against seizure risks in trap escalations. Fifth, empower with vigilance, track COMEX eligible weekly, BOFA updates quarterly, Fed dot plots monthly, tools like Kitco alerts or Bloomberg terminals arm you against noise, verifying the pattern's pulse to time without chasing shadows. The Fed trap's genius is its duality, cuts, beckon, buys, hawkish rebukes, test resolve, but gold's undervaluation endures. BOFA's $5,000, the beacon through fog. Choice crystallizes. Embrace physical now, thrive in eruption's gale, or spectate the transfer, regretting inaction as 5,000 spot mocks yesterday's hesitation. Every cycle favors the forewarned. This one's no exception. If gold's whisper at 4,216 resonates as roar in your gut, subscribe. I'll dissect the breakout beats in real time, from COMEX cracks to BRICS maneuvers. Comment below. $5,000 by 2026, or does the trap delay it? Your insights sharpen the edge. And tune in next. The veiled hands suppressing gold for decades, fines paid, shorts stacked, the playbook exposed, the trap sprung, position or perish.